Light is Britain's far-right conspiracy theory paper spreading hate and vicious lies. No, that's what the BBC say. The Light is the only national newspaper bringing you the real news and informed opinion on what's really going on today. You can subscribe, order copies, submit articles, and read back issues on our website, thelightpaper.co.uk, and see for yourself why the establishment are so worried about the uncensored truth getting out to people every month. The Light Paper. Not far right, just right so far. thelightpaper.co.uk.
Scene script. Have you ever pondered the idea of financial independence and early retirement? The notion of not having to clock in at 9 or wrestle with the daily grind? Imagine a life where you're not shackled by financial obligations or a demanding job. It's not an impossible dream, but a reality for those who embrace the FIRE movement. That's financial independence, retire early. Consider the tale of Jane, a woman in her early 30s. Jane was an ordinary person living an ordinary life. She had a 9-to-5 job, a mortgage, car payments, and a lifestyle that was comfortable but hardly extravagant. And like most people, she dreamed of a life where she didn't have to worry about money. Jane decided to make a change. She began by cutting back on non-essential expenses, saving as much of her income as possible. She invested wisely, focusing on assets that generated passive income that didn't require her to trade time for money. Slowly but surely, Jane began to build her financial independence. She was still working, but she was no longer living paycheck to paycheck. She had a safety net, a cushion that gave her the freedom to make choices based on what she wanted, not what she needed. Fast forward 10 years, Jane, now in her early 40s, had achieved her goal. She was financially independent. She had enough passive income to cover her living expenses, and she no longer needed to work to survive. She was free to retire early, to spend her time as she pleased. Jane's story may seem extraordinary, but it's not unique. It's the story of anyone who has embraced the principles of the FIRE movement. It's a tale of discipline, of sacrifice, and of a relentless pursuit of financial independence. To summarize, the key points discussed today revolve around the idea of financial independence and early retirement. It requires discipline and sacrifice, cutting back on non-essential expenses and saving as much as possible. It involves investing wisely, focusing on assets that generate passive income. But most importantly, it requires a change in mindset. It's about seeing money not as a means to buy things, but as a tool to buy freedom. It's about understanding the true value of time and the freedom that comes with not having to trade it for money. This is the essence of the FIRE movement. It's not just about retiring early, it's about achieving financial independence, about gaining the freedom to live life on your own terms. Like Jane, you too can embrace the principles of the FIRE movement and embark on a journey towards financial independence and early retirement. After all, the only thing standing between you and your financial freedom is you.
Ever wondered how much you'd need to save to achieve financial independence? The answer lies within the mathematics of a concept known as FIRE, which stands for Financial Independence, Retire Early. The most essential number in your journey to financial independence is calculated by multiplying your annual spend by 25. Notice the emphasis on annual spend, not annual income. This calculation is based on the principle that you need £300 invested for every pound you wish to spend each month in passive income. Hence, your FIRE number is also your monthly spend times 300. This mathematical principle is founded on the 4% safe withdrawal rate, as defined by financial advisor William Bengen. He proposed this rate after analyzing the S&P 500, which typically produces an average of better than 10% growth per year when studied over a period of approximately 30 years. Bengen considered factors such as inflation and market volatility. After studying previous market activity, he concluded that a 4% rate of withdrawal per year would provide for a 30-year sustainable portfolio in the vast majority of cases. So to paint a clearer picture, if your monthly spend is £1,000, then your target for financial independence is 300 times 1,000, or £300,000. Alternatively, if your annual spend is £12,000, your financial independence target is 25 times 12,000, which also equates to £300,000. The first step in planning your financial independence, therefore, lies in understanding your monthly and yearly expenditure. Without this knowledge, it is impossible to take further strides towards your financial freedom. In summary, the mathematics of FIRE revolves around the principle of multiplying your annual spend by 25 or your monthly spend by 300 based on the 4% safe withdrawal rate. Knowing your monthly and annual spend is crucial in determining the amount you need to save to achieve financial independence. Armed with this knowledge, you can then plan your journey towards financial freedom. Remember, the journey to financial independence is not a sprint, but a marathon. Embrace the mathematics of FIRE and take the first step towards your financial independence today.
My apologies, guys. I just realised I had not managed to turn on the microphone. Let's start again. So it is 11:50 on Monday, the 14th of July 2025, Bastille Day. That means that we have completed 3 years and 15 weeks of what will be roughly an 8-year FIRE journey or FIRE experiment. 8 years because that's the length of time needed to exhaust the £50,000 of free funds that come with the practice account on Trading 212. But I hadn't previously said this, and I suppose I hadn't really maybe thought it through very well, but when I have actually invested the total amount of the free funds, so basically let's say that would be the equivalent of when you would have finished your wealth accumulation phase, if you were doing this for real in terms of being ready to retire. My intention is to not to stop looking at the market and seeing what happens, but actually at that stage I plan to move to a withdrawal phase, and basically what I'll do is I'll use the 4% safe withdrawal number, and we will withdraw 4% of the portfolio per year. I'll do it over length of time, I suppose, in a kind of a representative way, perhaps, to what you might do if you were relying on the portfolio itself. And yeah, we'll see how that goes. Now, what I was going to say, sorry, I was just distracted by a noise at the post box there. But yeah, what I'll do is I'll have a look and see what the portfolio, how the portfolio would be affected subsequent to the 8 years of investment. The wealth accumulation stage then will move to a kind of a withdrawal stage, a drawdown, I suppose is the proper word. Drawing down probably monthly from the portfolio, and having a look to see what effects that has, and whether or not it continues to be sustainable going forward, because I think that is key. It's well and good showing you this part of the what's the word I'm looking for, as well and good showing you this part of the methodology, but we also need to consider the other part, which is probably arguably more important, because at the end of the day, if the portfolio doesn't sustain itself at a 4% safe withdrawal rate, then we have a problem. I fully expect that it will, but let's see that in reality, and we'll do that in another roughly 5 years' time. Guys, before I go ahead with the notifications, let me just draw your attention to Monzo.
I want a bank that makes money easy.
That sounds perfectly reasonable.
And you are?
We're a bank called Monzo.
I want a bank that shows me what I spend instantly.
No problem, just give us a go. See?
Can you make splitting bills easy?
Super easy, check this out.
But it's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on.
Can I talk to a real person 24/7?
Of course.
Even now?
Yep.
Even now?
Anytime.
Can you tell me when I'm running a little low on cash?
We certainly can.
Cool. Can I afford these?
You certainly can't, sorry. Can't afford that either.
That's a real shame.
Not really. Time's up, how'd you get on?
It's a draw.
Can you help me save for my next holiday?
Oh, how about you set up a savings pot in the Monzo app called Barbados, baby?
Thanks for listening, Monzo.
We're all ears.
We can go now.
Rude. You make Monzo Monzo.
Okay, now that we have seen that, let's have a look at the notifications. So the new notifications a couple of days ago, Aerovironnement up 10% after the US Defense Secretary pledges to unleash American drone dominance. Red Cat jumps 20% as US Defense Secretary orders expansion in drone production. Forgive me if I am not suspicious that those two might be linked. And then finally, Levi Strauss jumps 10% after rousing dividend in response to stellar Q2 results. And that's all the notifications there are. I'm actually surprised not to see some mention of Bastille Day in there. I would have thought the French market might be closed today, but maybe not. I genuinely don't know. Either way, let's move on. So as I've mentioned in the past, the two red circles you see on screen, one at the lower left represents the COVID effect and the V-shaped recovery that followed it. The one at the top right represents Donald Trump's tariffs announcements, and of course the V-shaped recovery that has followed that, although to be honest, so far I haven't actually heard anybody else refer to a second V-shaped recovery. But I mean, if you look at the graph, it's stark actually just how similar the two V's appear to be, because looking at the COVID one, the market kind of shot up fairly quickly until it had recovered a good half of what it had lost, and then it sort of leveled off a bit. And I think you could say that we've seen something very similar in more recent times. There was a great climb back, and then a little more of a leveling off, and some more green shoots following that again. The blue line on the screen there is just my attempt at drawing a sort of an average, attempting to get as much above as below the blue line, although I think actually that's probably not quite in the right spot, but I'm going to leave it alone anyway because it is what it is. And I do think that if you were to look at the figures for the market over, I don't know, 60, 70 years, you would probably see that in more recent times the increase is more of an exponential curve than a sort of an average straight trend line. That is my take on it, at least. Feel free to comment if that's not the case, or indeed if you have any other suggestions. So let's have a look at the figures. I don't think I had done that since I had the mic issue, but current price today 87.64, down 1/5%. The current portfolio value 25,250. Current return on investment 23%. We've got 288 shares in the market just now, and we have an average purchase price of 71.24, which will increase in a couple of seconds after I put in this week's £120 worth of investment. Same figure that I use every week. This week it's going to buy us roughly 1.36 shares. We will review it. It's a market order. The market is open, and let's see what we get. So we did indeed get 1.36 shares. They were bought at 87.67, and having a quick look just at the figures, I think the figures have updated. Yeah, they have, because it was 25,250, wasn't it? Previously, now we're looking at portfolio value 25,369. Return on investment just under 23% now, with that dollar cost averaging effect. Whenever you put in a purchase, it tends to average things slightly. The number of shares up to 289.5 almost, and the new average purchase price 71.32. I'm just trying to think if there is anything else that we have not covered as yet, and I don't think there is, other than, as I say, Bastille Day today. And I'm a little surprised. I did expect that there would have been some sort of a thing in the notifications about the French market either being closed or closing early, but I don't see that there. We've got the usual AI analysis as regards the S&P 500. It's a little, I had a look actually while I was waiting. It's not as positive as it might be. So what it says is the Vanguard S&P 500 exchange traded fund has experienced a steady upward trend over the past month, with prices rising by several percent and maintaining gains through the most recent sessions. Technical indicators such as the moving average and momentum readings are showing strong bullish signals, with the price consistently trading near the upper end of its recent range. I mean, you would expect that given that we're in a recovery stage, but it doesn't make reference to that. But anyway, moving on. Short-term technical measures indicate the exchange-traded fund is in an overbought condition and volatility remains low, suggesting the current rally may be due for a pause or minor correction. Sentiment. Recent social posts reflect positive investor sentiment, with individuals celebrating strong annual returns and expressing optimism about continued growth. Fundamentals. The Vanguard S&P 500 exchange-traded fund shows a moderate annualized return and a stable risk profile, with a market capitalization that reflects its position as a major index tracker. Dividend yield is present but not a primary driver, and the overall risk-adjusted performance is consistent with broad market exposure. In conclusion, overall, the Vanguard S&P 500 exchange-traded fund is demonstrating strong momentum and is currently in an overbought state, suggesting caution for new entries. The combination of positive sentiment, robust technicals and solid fundamentals supports a favourable long-term outlook, but short-term pullbacks may occur due to the extended technical readings. I suppose my own comment on the AI analysis is that it appears to be quite short-sighted in nature. The fact that it talks about prices rising by several percent and maintaining gains through the most recent sessions, but it does so in the absence of saying, well, prior to that we had quite the shoot, and really what the market is doing is making up lost ground. So yes, I mean, the AI analysis is not wrong, but I do feel that it's oversimplistic. And it doesn't really give a full picture. So I'm just scrolling down here to see what else appears here. There's a little bit on the stats. The stats have been changed in how they're presented. It looks as if I can actually open this, so I might give that a go in a second. But just to point out what it says. So for the 52 weeks, the highest price seen was 93.83, near enough. The lowest was 70.73. The volatility is rated as medium. Expense ratio 0.07%. Assets under management 33.96 billion. Dividend frequency quarterly and dividend yield 1.34%. And beneath that we've got annualized performance presented for 1 year, 3 years and 5 years. Nothing very impressive about those figures, to be honest. Then it gives us the fund allocation, and seemingly it will alert me if there's a 5% change within 1 day. Let's just open the thing for the... Okay, so that's just looking at the stats presented in a more sort of linear fashion. And I suppose it's interesting to note that, so this is looking at 52 weeks, and you can see that it notes the period low, £70.73, which is actually lower than the period start that it also gives, which was 81.07, and that's reflective of the fact that there was a dip, there was a pullback. Equally, of course, then we have the period high, which, as we know, we would expect to be higher than the current price. So yeah, that's all fair enough there. Guys, with that all said, that is pretty much it for this week. And I would like to thank you for watching. If you find the content of interest, if you're interested in following the journey, consider subscribing to the channel. If you particularly liked this episode, why not give it a thumbs up? And of course, comments, suggestions and questions welcome in the box beneath. But thanks for watching. Have a great end to your week, and I will be back next week with more. Bye for now.